Welcome to Global Capital Engine, where we decode the hidden mechanics of finance. Today we expose a $12 trillion secret. Beneath the calm surface of global markets, a massive tectonic shift is occurring. European banks are quietly leaving the dollar system. Official data shows a small decline, but the real story lies deep underwater. A $12 trillion exit is happening right now. The Treasury International Capital data, or TIC, only tells us about physical bonds. It completely misses the vast shadow banking system. Money is moving in reverse, not through public selling, but through the silent expiration of massive derivative contracts and currency swaps. This is not a loud crash, but a quiet withdrawal. The liquidity that powered the global economy is slowly being turned off. European institutions are unwinding their synthetic positions. They are refusing to renew the contracts that keep the dollar system fully lubricated. Why is this happening now? The answer lies in a combination of strict new banking regulations and a sudden geopolitical awakening. The structural demand for dollars is fading. Europe is realizing that relying on a weaponized currency is a dangerous long-term strategy. To understand the magnitude of this event, we must first understand what a Eurodollar actually is. It is not just currency. A Eurodollar is simply a US dollar deposit held in a bank outside the United States, beyond the reach of the Fed. These dollars create a massive web of synthetic debt. They exist on balance sheets, but are not backed by physical cash reserves. For decades, this system allowed Europe to borrow cheap dollars to fund global trade without actually holding the physical greenback currency. It was a golden era of easy credit. Banks could leverage their positions massively, creating money out of thin air via swaps. But this system relies entirely on trust and continuous rolling over of debt. If the music stops, the synthetic dollars vanish. Analysts looking at TIC data see a stable market. They are looking at the wrong map. The real action is off balance sheet. The physical bond market is dwarfed by the derivatives market. $12 trillion of synthetic exposure is currently being unwound. Smart money is watching the shadow banking indicators, not the headlines. The silent run on the dollar has already begun. When these contracts expire, the dollars don't go back to the US. They simply cease to exist. This is monetary destruction. How do you exit a $12 trillion position without crashing the market? You do it silently. You do it by doing nothing. European banks are not selling bonds in a panic. They are simply refusing to roll over the swaps when they mature. Imagine a loan that needs to be renewed every 3 months. When the date comes, the bank just says no. The debt vanishes. This creates a liquidity vacuum. The US banking system expects this funding to return, but the stream has been permanently blocked. Frankfurt is signaling a strategic retreat. The era of blindly funding US deficits through the Eurodollar market is coming to an end. They are restructuring their balance sheets. The goal is to reduce exposure to the dollar and increase holdings in sovereign assets. Every day, billions in swaps mature. Every day, fewer are renewed. It is a slow bleed that is draining the global dollar pool. This mechanism explains why the bond yields are rising despite the lack of massive selling. The demand side is simply evaporating. The Federal Reserve knows this. The swap line's usage indicates stress, but they cannot force foreign banks to borrow their currency. It is a checkmate in slow motion. The US dollar is losing its utility as the premier funding currency for the European bloc. What triggered this sudden change of heart? It was a specific moment in history that shattered the illusion of neutral money. When the US froze Russian assets, it sent a shockwave through every central bank boardroom in Europe and Asia. The message was clear. Your dollars are only yours if Washington agrees with your politics. The risk premium instantly skyrocketed. Europe realized they were vulnerable. If they could do it to a nuclear power, they could do it to anyone.
The Q3 losses
Simultaneously,
are unacceptable.
the Basel III Endgame regulations arrived. These new rules make it extremely expensive for banks to hold risky derivatives. Banks are now forced to hold more capital against their dollar positions. The math no longer works. The trade is no longer profitable. This regulatory pressure is the final nail in the coffin. It forces a deleveraging of the entire global financial system. The friction in the system is increasing. Moving capital across borders is becoming harder, costlier, and politically dangerous. We are moving from a unipolar financial world to a multipolar one. Europe is positioning itself to survive the transition. The consequences for the United States are severe. We are witnessing the formation of a liquidity black hole in Western markets. As foreign buyers step away, the US Treasury market becomes more volatile. There are fewer buyers to absorb the massive debt issuance. The US government needs to sell bonds to fund its deficit. Without European demand, domestic investors must soak up the supply. Watch the cross-currency basis. When it goes negative, it means there is a desperate shortage of dollars in the offshore market. This shortage isn't pushing prices up, it's causing the market to seize. Transactions that used to be routine are now failing. Global trade requires credit. As the Eurodollar shrinks, global trade slows down. This is the deflationary pulse we are feeling. The storm is approaching the US shores. The Federal Reserve may soon be forced to intervene as the buyer of last resort. So where is this $12 trillion going? It is not disappearing. It is migrating to three specific fortresses of safety. Fortress number 1, physical gold. Central banks are buying gold at the fastest pace in over 50 years. Gold has no counterparty risk. It cannot be frozen, printed, or defaulted on. It is the ultimate hedge against the dollar system. Fortress number 2, European sovereign bonds. Capital is coming home. Banks are buying their own government's debt to meet Basel requirements. Fortress number 3, strategic commodities. Energy and industrial metals are being hoarded as tangible assets of national security. Europe knows it needs real resources, not paper promises. The shift from financial assets to hard assets is accelerating rapidly. In a world of distrust, things you can touch, eat, or burn for energy become the new reserve currency. How should individual investors navigate this shift? We have developed a protocol to protect your wealth during this transition. Rule number 1, avoid synthetic dollar exposure. Leveraged ETFs and complex derivatives are the first to break in a liquidity crunch. Rule number 2, prioritize physical custody. If you don't hold it, you don't own it. Counterparty risk is at an all-time high. Rule number 3, watch the real yield. As the dollar unwinds, inflation in real assets is likely to persist for years. Diversify into the assets that central banks are buying. Follow the smart money into gold, energy, and essential commodities. This is not the end of the world, but it is the end of an era. The Eurodollar system is dying. A new financial order is being born. It will be more fragmented, more tangible, and less reliant on the United States. Those who understand this shift will thrive. Those who ignore it risk being trapped in a collapsing synthetic system. Stay informed. Subscribe to Global Capital Engine as we continue to track the most important financial story of our time. Thank you for watching. Prepare your portfolio, stay vigilant, and we will see you in the next report. Let us dig deeper into the mechanics. A Eurodollar is born when a dollar is deposited in a bank outside America. For example, a French company receives payment in dollars and deposits it in London. That deposit is now a Eurodollar. The London bank can then lend that dollar to a Korean firm.
LIBOR historically tracked higher than
The
SOFR,
Fed does not regulate this
following the
transaction at
transition
all.
date, SOFR
This
is now the
process
dominant
repeats.
benchmark rate.
The same dollar is lent out multiple times, creating a multiplier effect of synthetic money supply globally. This is the shadow banking system. It provided the liquidity for globalization, but it created a fragile tower of debt. The transition from LIBOR to SOFR was the first warning shot. It was an attempt to bring this market back on shore. But the market is too big to be tamed. Instead of complying, the market is simply shrinking and moving away. The complexity of these derivatives is so high that often only the bank's algorithms truly understand the total risk exposure. We are looking at a potential $12 trillion margin call. If this unwinds too fast, it crashes everything. Central banks are trying to manage a controlled demolition. They want a slow leak, not a dam burst. It is not just Europe. Asian banks are also part of this network, and they are watching Europe's exit strategy closely. China is building its own parallel system, but for now, the focus is on the immediate contraction of dollar credit. A dollar shortage paradoxically pushes the dollar value up initially, creating a wrecking ball for emerging market economies. Emerging markets with dollar debt are the first victims. As Europe withdraws liquidity, these nations face a funding crisis. This is why commodities are vital. Selling copper and oil is the only way these nations can generate dollars to pay debts. We are entering a cycle where hard assets outperform financial assets. The paper economy is shrinking. The real economy is growing. Private wealth is also moving. Family offices are increasing allocations to gold and land, mirroring the central bank moves. Digital assets like Bitcoin are also reacting to this liquidity shift, acting as a smoke alarm for the fiat currency fire. The spread between US and German bond yields tells the story. Capital is choosing safety in Europe over yield in America. Europe is attempting to ring-fence its economy. By keeping capital within the Eurozone, they hope to insulate against US volatility. The parallels to the 1970s are striking. A supply shock combined with a monetary regime change creates instability. History does not repeat, but it rhymes. The unwinding of the Eurodollar is the rhyme to the collapse of Bretton Woods. The US debt trajectory is unsustainable without foreign funding. The Eurodollar exit exposes the US fiscal situation nakedly. Political gridlock in Washington makes the situation worse. There is no political will to fix the structural deficit issues. Pension funds are the most at risk. They hold the long-duration assets that suffer most when liquidity dries up. Real estate is not immune. As the Eurodollar dries up, the cost of funding for mortgages globally will remain elevated. Projects that made sense at 0% interest rates are now abandoned. The capital allocation is becoming more disciplined. Capital will flow to productivity. Companies that actually make things and generate cash will survive. Zombie companies will fail. The green energy transition is also resource intensive. It requires massive amounts of copper, nickel, and lithium, not just dollars. New trade corridors are forming. Intra-Eurasian trade is growing, settling in local currencies rather than the US dollar. Bilateral trade deals are bypassing the SWIFT system. This reduces the demand for Eurodollars even further. Alternative payment systems are gaining traction. They are small now, but they are growing as insurance against sanctions. The trend is undeniable. The dollar's share of global reserves is slowly but steadily declining year after year. We are in the twilight of the Eurodollar age. It served its purpose, but the world has outgrown it. The lights are not going out, but they are dimming in the west and brightening in the east and south. The BRICS expansion is a direct response to the weaponization of the dollar. They are building a lifeboat. Food security is national security. Countries are prioritizing stockpiling food and fertilizer over holding U.S. Treasury bonds. The inputs for life are becoming more valuable than the financial instruments used to speculate on them. For the average investor, this environment is disorienting. The old rules of the 60-40 portfolio no longer apply. Bonds no longer offer the protection they once did. In an inflationary unwind, both stocks and bonds can fall together. Cash is not trash, but it is a melting ice cube. You need it for liquidity, but holding too much is dangerous. Productive land is a key asset class. Farmland, timberland, and water rights are the ultimate defensive positions. Water is the oil of the 21st century. Investments in water infrastructure and technology will be crucial. Energy independence is wealth. Producing your own power protects you from the volatile energy markets of the future. Oil remains the master commodity. Despite the green push, the world still runs on oil, and supply is tight. Underinvestment in oil extraction means supply shocks are inevitable. This will keep inflation sticky and persistent. For the consumer, this means higher prices for imported goods. The strong dollar helps now, but that will reverse. When the unwinding accelerates, the dollar could weaken sharply. This will import inflation back into the United States. The Fed will be trapped. They will have to choose between saving the bond market or fighting inflation. They cannot do both. History suggests they will choose to save the system. This means yield curve control and more money printing eventually. This future pivot will be the signal for the next leg up in hard assets. You want to be positioned before that happens. Let's recap the protocol. First, eliminate leverage. Do not borrow to invest in this volatile environment. Second, accumulate real assets. Gold, silver, commodities, and productive land. Things that cannot be debased. Third, practice self-custody. Do not leave significant wealth on exchanges or in precarious financial institutions. Fourth, be patient. This is a structural shift that will play out over years, not days or weeks. The path ahead is steep and rocky, but for the prepared investor, it offers generational opportunities. Knowledge is your best asset. Understanding the plumbing of the financial system gives you an edge over the herd. Share this information. Discuss it with your network. We are stronger when we navigate these changes together. The global capital engine is being rebuilt. The old engine is sputtering. The new one is just coming online. Do not be afraid of the change. Embrace it. Volatility is simply the transfer of wealth from the impatient to the patient. The river of capital is finding a new course. You cannot stop the river, but you can build your house on high ground. $12 trillion is on the move. It is the biggest reallocation of capital in our lifetimes. Europe is leading the exit. They are prioritizing their own sovereignty over the convenience of the dollar system. Real assets are reclaiming their throne. The 40-year bull market in paper assets is officially over. Global Capital Engine will continue to be your lighthouse. We watch the data so you don't have to. Our team is constantly monitoring the TIC data, the swap lines, and the derivative markets for the next signal. If you found value in this analysis, please like the video. It helps the algorithm share this truth with more people. What are your thoughts? Are you moving into gold or staying in cash? Let us know in the comments below. Check out our previous videos on central bank gold buying for more context on this massive shift. Remember the words of Benjamin Graham. In the long run, the market weighs the truth. The truth is heavy. The truth is that the dollar is overvalued and real assets are undervalued. The market will eventually correct this imbalance. The financial universe is vast and complex, but the laws of economics, like gravity, always apply eventually. Timing is everything. You do not need to be early, but you cannot afford to be late. Take this time to review your own strategy. Consult with professionals who understand the macro landscape. Ultimately, wealth is about freedom and security for you and your family. Protect it wisely. We are zooming out to see the big picture. The daily noise distracts, but the trend defines the outcome. Global Capital Engine is dedicated to providing you with that big picture perspective every single week. In our next episode, we will explore the rise of central bank digital currencies and what they mean for your privacy. Make sure you have the notification bell turned on so you do not miss that critical update. Chance favors the prepared mind. You are now armed with information that few others possess. Use it well. Navigate with confidence. The future belongs to those who see it coming. This has been a Global Capital Engine production. Research-driven, data-backed, and truth-seeking. Thank you for watching Global Capital Engine. Subscribe to stay ahead of the curve as we navigate this new financial world.